Let's examine Titan FX. They operate out of offshore jurisdictions like Vanuatu and the Seychelles. By setting up shop outside the authority of Tier 1 regulators like the SEC or the FCA, they can offer something those watchdogs ban: extreme leverage, up to 1,000 to 1. They pair that offshore regulatory freedom with Wall Street hardware. Their primary trading infrastructure is housed in the Equinix NY4 data center in New York. This quadrant chart plots regulatory strictness against execution technology. You will find Titan FX sitting squarely in the top left corner. Low regulatory handholding, but institutional-grade execution speeds and massive leverage. That specific combination means the safety nets usually provided by major governments are gone. The entire burden of risk management falls directly on your operational choices. To connect to those NY4 servers, Titan FX offers 3 specialized pipelines: the standard, blade, and micro accounts. Having institutional execution speeds is useless if you pay the wrong toll to access the market. Your account's fee structure has to mathematically match how often you trade. Run a high-frequency scalping algorithm on an account that charges wider spreads, and the math will eat your profit margins alive on every single tick. We need to map your specific trading strategy, frequency, and starting capital to the exact right account setup. Securing your profitability on Titan FX means solving your operational math before you ever click buy on a live trade. Before we split these accounts apart, there are 2 strict risk management rules that govern all of them. First is the zero-loss system. Think of this as negative balance protection. If a massive market gap pushes your positions deep into the red, this system resets your balance to 0, preventing you from owing Titan FX money beyond what you initially did. Second is a 20% margin maintenance stop-out level. If your margin drops to this exact threshold, the system steps in and automatically liquidates your positions. Combined with 1,000 to 1 leverage and a tight 20% stop-out trigger, normal market volatility can wipe you out rapidly. Your position sizing must be incredibly precise. Look at this bar chart comparing fee structures. The standard account uses the model on the left. It charges 0 commissions on your trades, offsetting that by taking a slightly wider spread that starts at 1.0 pips. Keeping costs tied entirely to the spread simplifies accounting. You know exactly what a trade costs instantly. It uses straight-through processing to give access to Titan FX's entire catalog of nearly 300 assets, covering Forex, crypto, metals, and index CFDs. The limitation here is volume. If you are entering and exiting the market dozens of times an hour, a 1.0 pip spread creates far too much mathematical drag for a short-term scalper to overcome. The standard account is built for swing traders. If you hold positions for days and value asset variety over shaving micro pips off your entry price, this is your environment. The Blade account flips that fee structure completely. You pay a $3.50 commission per lot per side, but your spreads drop down to raw market rates, as low as 0.0 pips. Paying an upfront cash fee sounds expensive, but if you trade high volumes, paying the commission to secure a 0-pip spread results in the lowest total transaction cost over time. This flowchart shows the Blade account routing. It uses a no-dealing desk ECN model. Orders bypass internal intervention, matching directly with external liquidity for a 99.8% fill rate. The trade-off? During major news, liquidity can vanish, meaning your orders suffer slippage. Despite news volatility, the Blade account is mandatory for automated expert advisors. Algorithms demand tight execution. Artificial spread whitening breaks their logic. The micro account scales everything down to the foundation. You trade in micro lots of 1,000 currency units, but with access to an extreme 1,000 to 1 leverage ratio. This setup allows you to take meaningful market positions using microscopic amounts of initial capital. But the cost of that leverage is variety. You are locked out of the wider catalog and restricted to a highly limited pool of just 37 assets. That restriction makes the micro account an ideal proving ground. It bridges the gap between the safety of a demo account and the brutal psychological reality of live trading. You sacrifice market breadth to eliminate the financial barrier of entry, allowing you to forward test your strategies with real money on the line. Let's map your strategy on a decision tree. For high frequency or algorithms, follow the path to the Blade account. For low manual frequency needing diverse assets, it's the standard account. If starting under $200 to test discipline, choose micro. All 3 plug into the exact same high-speed Equinix servers in New York. But those speeds are useless if you pay the wrong toll for your strategy. Titan FX is a highly specialized tool. It is built for traders who prioritize raw execution speed and extreme leverage over everything else. You must be completely comfortable operating outside of heavily regulated Tier 1 jurisdictions, like here in the British Virgin Islands. But it is exactly that lack of tight regulatory oversight that makes 500-to-1 leverage and total algorithmic freedom possible. To succeed here, you have to be disciplined enough to replace the hand-holding of a government regulator with your own strict, uncompromising risk management.